right. Good morning, good afternoon, everybody. I hope everyone just had a pretty good lunch and hopefully not also dozing off soon. But anyway, I think thank you again for having me today, especially from Andrew and Kevin for this event. I really appreciate you inviting me over and my company over to present some of our views around energy transition. Just before I start, I think one thing I would like to introduce myself. My name is Sam Chua. I'm a principal consultant with Rystad advisory team. I have over 10 years of experience looking at the sector, be it in the energy transition landscape, energy companies, as well as the offshore sector. So today, I will be presenting my views around what is our perspective of the pace of energy transition in the offshore sector and what are the potential implications for various stakeholders. So just a very, very quick slide overview of who we really are. We are primarily an energy advisory business intelligence service provider. We originated from, our heritage comes from Oslo, Norway, where we've developed our office there in 2004. And gradually, I think as of today, I think we are a 20-year-old company. And we have leading energy advisory services, experience in strategy, business development, and transaction advisory across all the energy landscape. We have a wealth of global business intelligence databases, which helps to inform us a lot of the deep insight views that we see in today's market. So this is generally our view of how the energy map looks like from our perspective. We have done, just to highlight to you, we track every single molecule and electron from the start of, the primary source all the way to the end demand sector. So as you can see, I think for each of those boxes there, we have, very detailed databases that underpins our analysis and flows. And this helps to influence our view of how energy is likely to transform and evolve over time. So for example, I think for the purposes of this, we track, especially for the natural gas and oil, which is, you can see in the middle of the starting point, we do track flows from upstream assets level all the way through pipelines, and we do track the capacity of pipelines, the development of pipelines, as well as other forms of infrastructure point of view. We also look at it down to downstream sector, where we've done a lot of we do track a lot of the developments at the downstream space, how much offtake is likely to take off, and this helps to give us a very good view of potential availability, utilization, and then going beyond that, we can look at the form of how energy flows towards like gas turbine, which is more of the power sector. In that sense, I think sometimes we do track like flows all the way from the upstream asset, for example, like for example, in Indonesia, I think there are certain selective gas fields that we do track all the way the flows through the transmission pipeline, through PGN pipelines as well, all the way up to the upstream sector. So basically, I think from what I'm trying to say here is that from this chart, we do track everything, and this helps to validate some of our views, and we are very happy to share some of this from our end. This is probably a last introductory slide of what we do. We have done over 3,000 advisory projects, and we advise more than 500 companies in this space. So as you can see from the pie chart there, I think we've done a lot of work for government, investors, as well as energy companies and service companies, particularly in this segment here. Okay. So without further ado, let me just jump straight to the next section where we talk a little bit more about our perspective around the offshore market. So today's session is something to be one that I would say is more of a light touch or maybe a broader perspective of what are the key trends that we see in today's market, especially from the offshore segment. So this is, I think, the first slide we want to highlight one thing here. I think right now we've seen that the current macro oil price climate is relatively robust. I think with regards to the events that happened over the week, I think it has also provided a little bit of support for oil prices to remain in the range of around $80 to $90 in the short term. And what we see is that sustained oil prices as well as energy supply concerns have led to a lot more higher industry investments and commitments and spending. So this is what we've actually tracked in terms of all the company spending, in terms of guided increases in 2024 upstream investments. Very clearly, I think you can see from top all the way down to the bottom, these are the top 10 IOC or NOC companies. as indicated from the black bar, which is 2024 versus 2023, there is a net increase if you look at it from an overall company's perspective, which is about 4%. And all of these things would translate to, increase investments in the offshore sector as well as other sectors. But we do, from that perspective, I think you can see that basically from our forecasting wise, we do see that offshore E&P drilling spending is likely to increase from, I think from the last year, it's about close to 20 billion USD. I think going forward, we do see the range to be around 25 USD billion for 2024 to 2030. So again, one thing I'd like to highlight here is two things. One is, of course, this is not a trend that we see across all companies that are increasing their commitments. Of course, various companies have different level of developments and pace in doing so. So sometimes there may be some substantial decreases like ExxonMobil, which is, as of now, I think most of their investments into Guyana is tailing off as well. And hence probably that will explain why it's slightly reduced. But for various companies, I think the very remarkable one is Petrobras. We do see that they are expecting to see an uptick about 30% more investments. So again, that would also translate to potentially more offshore spending in those areas like Brazil. So of course, I think from the offshore drilling market, spending wise, Rystad Energy also tracks and forecasts how rig demand and vessel demands are likely to translate in these areas. Overall, we do see that there are few things. One is that we do expect offshore rig and vessels market to see sustained uptick, and they were likely to track very closely with drilling activities. I think on the chart on the left, we just showcase like how we view like in terms of rig years, how rig demand is likely to increase. I think most of the increase would likely come from jackup rigs versus floaters, which would likely be flatter versus jackup rigs. But overall, I think you do see that the demand does not track one-to-one versus spending, which I will actually explain in the next few slides. The second one, I think, is more around vessel demand types. Overall, we do see that, in terms of offshore construction, platform supply, as well as anchor handling, most of which will also see some uptick. But of course, I think the main driver is primarily around platform supply, as you can see there from the black color portion there. So that is the one that has seen driving most of the increase in those segments. So basically, I think from that it was the current situation that we're seeing. But overall, I think when we look at it from an energy transition perspective, we have many various views about this. So we have actually, from Rystad Energy's perspective, we do track all energy scenarios by 0.1 degree increment from 1.5 or 1.6 all the way to 2.2 degrees. But what I'm going to show here is basically kind of our views on base case, low case, and high case. So our base case view is that Rystad believes in a 1.9 degrees trajectory all the way up to 2050. So this is where we view that the world would likely translate to in terms of the energy mix, the overall guidance for temperature increases, which translates down to energy investments and energy mix going forward. So 1.9 degrees is our base view. 2.2 degrees is our view of a high case, where we view that the world will sustain more, remain on a higher trajectory in terms of temperature increases, and hence I think the diversification point from away from oil and gas remains steadfast through to 2050. Beyond that, 1.6 degrees is our low case, and this is where we view that energy transition would happen at a much accelerated, faster pace. So basically, I think from this slide, it is very interesting to see a few key notes here. One is, I think from our base case, we view that, basically, renewable share is likely to increase substantially, all the way up to close to 50% by 2050. Today, it is, I think, in the range of around under 20% or 20% range. But one thing I think, of course, pertaining to this sector is looking at the amount of green and red that we're seeing going forward. So today we are seeing it's about 23 to 31%. Overall, I think this is close to about 54% or 55% of energy mix. And this also translates to, offshore activity as an indication. Going forward, I think energy transition impact would be material, as we do expect to see oil and gas likely to drop in tandem with increasing renewables dependency and integration of, sustainable solutions in this sector. So we do see that base case oil and gas demand are likely to drop. But if you look at it from a high case, I think you can see that basically oil and gas is likely to remain sustained all the way through to 2050 versus the percentage of 40% that you see in the base case from 2050 up to about close to 51% or 50% that will still remain to be oil and gas. But if you were to assume that a lot of the policy guidance and investment trends are likely to trend in a very aggressive low case, where we see energy transitions evolving a lot more aggressively, then we do see that renewable share becomes 73% of the energy mix by 2050. And that is where you see the direct impact would hit. Primarily one is coal, and the second, the next few will be definitely along the same value chain of oil and gas as well, where we do see that there will be material declines in that aspect. But this is not to say that any one of these events are definitely going to happen. This is just a scenario view of what is likely to happen. Again, like I said, every one of these really depends on how each policy momentum is likely to evolve, likely with technology developments that we see in the sector as well. So one thing I highlight here is that Rystad Energy consistently monitors the way how the pace of energy transition is going, and we will adapt these views accordingly. So 20 years from now, these trends will definitely change for sure. So, but I think from today's perspective, this gives us a very good idea of how much potential opportunities and risks that we expect to see across these three scenario cases. So basically, I think what we have actually highlighted here is that we, in this chart here, I think we want to highlight what is the overall oil and gas demand that we're seeing so far. So this is the same numbers that you see previously, but we have extracted like our views of 2.2 degrees, 1.9 degrees, and 1.6. Overall, we do see that oil and gas demand are likely to see material impact, and this will actually translate to potentially higher uncertainty for the offshore sector. So how does this really impact? I think we see in two different ways. One is that energy transition typically denotes that there will be higher diversification away from the traditional fuels of oil and gas, and this would result in higher demand for renewables versus oil and gas, and this also would result in higher increased regulatory and compliance costs, all of which will actually drive a lot of market signals for price fundamentals to decline going forward. And this will actually result in less economic fuels, and of course investments will shift away from oil and gas, and inevitably lesser spending diverted to the offshore sector, and thus this also potentially could result in lower rig and vessel demand. But like I say again, this is depending on the pace of energy transition, not necessarily that this would definitely happen, and 1.6 degree scenarios is not a likely event that will happen as of today. So this is how we see it, but of course the magnitude of it also depends on what degree scenarios we are seeing again. But as of today, I think from 2050, we do see oil and gas demand to be around in the range of 130 million barrels per day. But of course, I think 2.2, we see that this is going to be significantly higher at about 160 to 170 million barrels versus, in the very aggressive case of 1.6, this goes down to close to 50. So you can see that the magnitude of impact also really differs. But of course, I think that's where we want to see what are the potential areas where different players have adopted different means to actually navigate through these uncertain times as well. So this is just our view. Again, another one that what we have actually shown here, I think it is the same numbers as you see earlier on in the form of rig demand and vessel spending. One thing we'll highlight here is that what we have done is that we have actually categorically labeled like different assets and with their risk profiles to the energy transition trends. So what you're seeing here is that because Rystad Energy tracks every single asset, rigs, offshore vessels, and we do calculate their break-even prices in the form of oil break-even prices. And for these ranges, I think basically what we are measuring here is the form of energy transition risk that we are seeing. So what typically denotes as gray would be sanctioned, and these are already committed as long-term or short-term and long-term offtakes going forward. But going forward, I think you can see that there are some that are not sanctioned yet, but they operate within different break-even price ranges. So for example, I think the green color range would denote that they have break-evens of below $40 USD per barrel. So even in an energy transition case, I think under $40 oil price would remain relatively resilient in those markets. In the medium energy transition risk, that would consider all assets that are operating or obtaining a break-even within the range of $40 to $60. So this is considered to be medium, and for high, this is something that any break-even that is above $60. Again, this is just an independent perspective of the different ranges. Of course, every different company as well as player have very different views on, you know, what is the threshold or what is the ban for this. So, but of course, this is highlighting one thing. I think generally you can see that there is quite a huge chunk of rigs and vessels out there that are relatively green. So they would relatively remain resilient through energy transition. Of course, I think for the vessel side, there is, of course, a slightly higher risk in terms of the medium energy transition risk and rate as well. So of course, I think this would actually translate to potential impact where, you know, in the event where there's a decreased oil and gas activities, I think those red and orange would likely see higher risk of, you know, becoming less relevant or underutilized for that aspect as well. So that brings us to the next point. How do we actually foresee offshore players adapting in the face of energy transition pace, and if it were to increase further? So there are three spectrums that, before I jump into that, there are three spectrums that we look at. One is, I think there are 3Ds that we look at internally as well. One is more of defending their own position. The second one is more around decarbonizing their portfolios. And the third is more around making sure that they diversify at a gradual pace against traditional oil and gas businesses. So for the first one, I think it's more around defense position. I think a lot of players, I think we have seen historically, and I think going forward, this is likely to continue, but of course not at such an aggressive pace. But it's more around how they have consolidated their fleets as well and their positions to become more competitive going forward. So what you're seeing here, I think the first chart on the left-hand side is more around like the rig supply chain that we see. We have seen historically there have been a lot of, you know, retirement of older rigs in the market. And if you translate that to new builds, I think very clearly you can see that the height of the gray bars exceed the orange and the dark black bars as well. So that would translate that there is a lot of general retirements that's happening historically. Going forward, I think you can see that the pace is a lot more aggressive, where the addition of new vessels are a lot smaller going forward. Of course, I think 2023, we see lesser retirements. There is some net addition in vessels, but I think this is also because of the macro oil market that we're seeing today. And some people may have the view that oil prices are likely to see sustained levels going forward. But we do not expect to see that there will be such an aggressive return back to, you know, higher vessel supply going in the market going forward. And that what really that translates to is that generally, because of the consolidation or the reduction in fleets, we do see that I think the sector has seen a lot more higher utilization going forward as well. And this is just a matter of demand and supply balances, because, you know, as over time we do see that there is sustained demand going forward, but supply is dropping, and hence a lot of the jackup rigs and floater rigs have seen higher return back to, you know, higher utilization going forward. So not necessarily that, you know, what we are seeing so far and what going forward may be a bad thing for the offshore sector as well. I would say that the offshore sector has actually re-optimized and also reconsolidated their position to be a lot more competitive. And this is also reflected in the next point that you see on the right hand side, where there are notable M&A activities in the offshore market. Of course, these are a little bit dated, but there's a few things we'll highlight here. Of course, we still see that Noble, for example, has acquired Pacific Drilling in the past. Noble and Maersk merger as well as other sectors such as the other offshore service vessels segments, where they have acquired more vessels to strengthen their fleet as a whole. So of course, we do see that they have actually consolidated for a variety of reasons. One is more around the fact of enhancing its market position, or merging to actually scale up economies of scale. And lastly, also more around growth and business diversification, as well as strengthening their own fleet. Next point is more around decarbonization. Of course, I think from the point of energy transition point of view, we do see that there will be increased regulatory and compliance costs going forward. And this would translate to, you know, higher costs potentially incurred at the rig levels, as well as, you know, potentially there are financing, banks and financial institutions out there. They are looking at ESG matrices for some of these companies. So a lot of these companies that we are seeing today have actually adopted a lot more emission reduction technologies. Again, one thing I'll highlight here, that the number of rigs that are adopting this is not at a very high level. This is just that we are seeing that it's starting to take pace. For example, like energy management is one way of improving their energy optimization. Onshore rigs, as of today, we see about 18 rigs that have already undertaken some of these technological improvements. in terms of reducing the emissions through catalytic reduction systems, as well as battery power ways to actually reduce their emissions from fuels, as well as other fugitive emissions. And likewise, I think there are other opportunities or technologies that they have pursued as well, but not at the same pace. So we do see that this is increasing in momentum, but at a very gradual pace. So if we look at it more from the fuels perspective, I think the right-hand side is looking at vessels that are tracking based on their fuel types going forward, based on the order books that we are seeing so far. Conventional fuel, of course, still remains the dominant one, and we're talking about fuel oil as well as diesel engines for vessels. But I think going forward, you see that the size of LNG is growing quite substantially from order books perspective. And new vessels wise, I think if you were to color like anything beyond the dark blue onwards, about 20% of them are likely to be low carbon fuels ready. And what this means is more around ammonia and methanol ready. But one thing I like to caveat here is that it doesn't mean that they are going 100% methanol or 100% ammonia. What this means is that they are ready, and these vessels are capable of using either one of the fuels, but predominantly they will still be very reliant on the conventional fuel or LNG fuels as per se. So one key thing I like here, yes, there are players that are looking to decarbonize their portfolio in a good way, but this is happening at a very gradual pace. Lastly, I think this is more around diversification. Again, another segment that players are also looking at. They have actually expanded and entering into the new energy teams such as CCUS and offshore wind. So what do we mean by this aspect? There are, I think again, we do track rigs in terms of how they are contracted out for certain work types, and we do see that there is some momentum for CCUS drilling and site surveys as well as developments in this region and globally as well, as we see. So you can see that the size of the orange bar, as you can see from the rigs perspective, is growing, and it will likely peak in 2026 to 2027 before it decreases slightly. Again, this is just a current position point of view that we see going forward. I think as time and years goes by, of course, this view may see higher forms of orange bars going forward because of depending on the announcements that we see. But all of these are based on announcements that we are aware of and we track today. From offshore vessels, I think very interestingly, you can see offshore wind is a very growing segment. From what we are seeing over here in 2023, I think the size of the bar kind of doubles all the way out to 2030. So I think this is another very interesting segment that you see a lot of vessels or operators have been offering as part of their product offering, aside from just staying attuned or strong to their oil and gas offerings, as per se. So offering services in the offshore wind segment, I think is one area that some players are looking at. CCUS, I think comparatively does not look as prospective as versus offshore wind, but one thing I like to say that this is a potential area to look at also, depending on how policy evolution takes place. For example, I think this is a very, very emerging field. I think, for example, we see that Indonesia is one area that just announced their CCUS regulations. So all these things will only start to take pace and move along depending on regulations. Offshore wind, I think, is a little bit more commercial in that aspect. So I think from a private perspective, I think the momentum is already quite self-sufficient, but CCUS still remains to be very reliant on regulation support. So that's why I think that the size of the orange bar would likely grow depending on how fast this new regulatory support comes in, or commitments that comes from other governments. So overall, I think just a few things, and I just have 1 or 2 more minutes before I end this, but I think this is my last slide. So basically, we do see that the offshore sector is well positioned based on what we are seeing in terms of their market consolidation as well as their rationalization of their portfolios. But going forward, I think it must continuously adapt to energy transition challenges. So we do see that there will be sustained uptake through to 2030. But despite all the energy transition risks that we do foresee, there will be impact in the form of lower oil and gas demand and higher regulatory costs, which also impacts prices and also affect spending, which also translates to offshore rigs and vessel demand impact. However, I think there are various different options that we see here. What we drew here, it is a triangle on the right hand side that various players are looking to do 3 different measures. One is defending their position, diversifying, and decarbonization. And we're not saying that any one of these players would pick one of this. They would pick either one or more of these options. And what options should they actually consider? So what does this really mean for, you know, potential finance institutions as well as other operators as well? I think one is for operators, they must continuously make sure that they remain very resilient in their portfolio, making sure that in the form of their portfolio they are competitive going forward. And what does this really mean for finance institutions? I think also to look for such companies that are equally well positioned, be it in the form of energy transition or in place of, you know, in the oil and gas sector, they are very, very competitive. I think those are the opportunities that we should kind of focus our attention to. And going forward, I think this is where we have done a lot of work in this aspect to help to, you know, do transaction support, opportunity screening, asset, you know, deep dives into these areas for this sector. Okay. So this is kind of my last slide, but thank you very much for the presentation, and I'm very happy to speak to you after this call. Thank you.